But thank you for joining us today at Impact Capital Forum. We have the honor of having Steve Glickman join us and Perry Teicher as co-moderator. To the extent that there are any Q&A, we welcome them to be inserted into the Q&A box. And as time permits, at the end of this conversation, we'll open this up for everyone to sort of share their thoughts. But in the interim, please feel free to insert comments into the group chat, which Scott will be monitoring, our chair of marketing, just to raise any questions that may come up in the process. So we are so honored and privileged to have Steve Glickman with us. Steve is, I hesitate to say the grandfather of the OZ legislation, and I correct myself and say the architect of this OZ legislation.
I get older each time we do this.
Yeah, you get older. Well,
you're the great grandfather of this now.
I feel that way.
So the great grandfather of the OZ legislation. By the time in 10 years, you'll be you could maybe arguably be
dead. I'll be dead in 10 years, so don't worry about that.
So Steve Glickman is the founder and CEO of Develop LLC, the nation's leading advisory firm dedicated to building and supporting opportunity zone funds, seeking to positively transform low-income communities across America. He is one of the nation's top opportunity zone experts who is sought after as a speaker around the country and as a thought leader. So thank you for making time to be with us today, Steve. In addition to these responsibilities, Steve is the co-founder and former CEO of the Economic Innovation Group, EIG, which is a bipartisan research and policy organization in Washington focused on addressing economic equality through the creation of a new marketplace for private equity investments in distressed communities. Under Steve's leadership, EIG was the architect of the $6 trillion Qualified Opportunity Zone program, the largest community investment incentive in U.S. history. Steve sits on Georgetown's Board of Governors and the Board of the New Deal, and previously served in the Obama administration from 2008 to 2013 as a senior economic advisor. Steve also held the position of Deputy Associate Counsel at the White House, as well as Chief of Staff for the U.S. and Foreign Commercial Service at the U.S. Department of Commerce. I'll also take the opportunity to introduce Perry Teicher, who leads the Orrick's Impact Finance and Investment Practice, a global initiative supporting entrepreneurs and investors looking to create intentional, sustainable, and measurable environmental and social impact in their communities and globally. In addition to developing and implementing Orrick's impact strategy, integrating revenue generating and pro bono representation, Perry represents early stage entrepreneurs in the US and across emerging markets, developing and growing their businesses, managing fundraising, intellectual property, and other legal needs. Alongside his role at Orrick, Perry sits on the Nexus Impact Investing Working Group leadership team, along with myself, and on the board of directors at Levin, the Jewish Communities Impact Investing Network. Perry serves on the board of directors at the Joint Distribution Committee, the world's largest Jewish humanitarian organization supporting Jewish humanitarian needs and the communities in crisis for over 100 years. And I'm Carolyn Allwin. I sit on this board at Nexus with Perry, as well as I'm the co-founder of Recap Investing, which is a robo-advisor focused on sustainable investing. And in this capacity, I'm chair of the thought leadership at Impact Capital Forum. So we welcome feedback on this event and any thoughts that you may have. So take it away, Perry.
Great. Well, it's always embarrassing when you read off that bio. It just is way too long for what it is.
Most of it's untrue, if it makes you feel better.
What? Wait, what was that?
I said most of it's untrue, if you feel any better about
it. For yours? I mean, it's really for mine.
For mine.
I think that's a good segue into questions about what we're talking about. Steve, could you give us a lay of the landscape sort of pre-COVID, right? I think that we're all in this COVID mentality, COVID experience where we are right now. So where were opportunity zones prior to the pandemic hitting and everyone being shut down for months on it?
Yeah, so just maybe as a little bit of a background context for folks. I'm not sure how much background everyone has on opportunity zones, but opportunity zones are a very new community invested, market oriented community development program that was created by Congress at the end of 2017. And for the last 2 years, really until December of last year, have been going through stages of formation of that marketplace. So it first started with governors in every state and the mayor in DC, the governors of the major territories picking the opportunity zones that would make up this map of these incentivized communities, or these places where you would be able to get incentivized investment. That happened June of 2018. There are 8,766 of those communities that are basically made up as census tract size zones that are set up all over the country. They're about 10 to 12% of the country, about 2/3 urban, 1/3 rural. So this is a big part of the country that's now opportunity zones, and it's everywhere from the whole central business districts of cities to large swaths of rural areas, particularly in the Midwest, in the West and the South, to everything in between. Over the course of between the end of 2018 and the end of 2019, Treasury and the IRS wrote all the rules of the program, which are hundreds and hundreds of pages of regulations about how you can invest in opportunity zones in a way to take advantage of the tax treatment. And that process finished in the end of 2019. Let me talk really quickly just of how the program works as a 1-minute primer. Opportunity zones are set up as a way to incentivize the rollover of capital gains, which you get from the sale of just about any assets, stock in a private company or in a public company, or real estate or art. And rather than paying taxes on it immediately, you're able to defer payment of taxes if you invest in these opportunity zone communities until 2027. So you pay taxes that year. And in the meantime, whatever you investment is basically growing tax-free. And if you hold that investment for 10 years or more, and after that point, you then sell it, and you can hold it for longer than 10 years, whatever new profits that you have in that investment are totally tax-free. Everyone's got to pay back the tax on the rollover eventually, but it's a way to invest basically pre-tax dollars, and at the tail end not pay taxes on it. Why would the government do it? Because Congress, and I think lots of other people increasingly around the country, have recognized we've basically got a huge hole in the way we make investments around the country. And that falls in lots of different buckets. It falls within the footprint of banks around the country, around the footprint of venture capital investing, around the footprint of how larger banks invest and whether they invest in small businesses, and the realization that one of the biggest divides we see in the country, which is atypical of the way growth has happened in the US, is that in a time when the economy was growing rapidly over the last 10 years, the homes of roughly 50 million Americans were going the opposite direction. They were in decline. The pandemic has obviously accentuated a lot of those inequalities, but now we've got this infrastructure in place that enables private capital to flow to those areas, hopefully. And in 2019, we saw a pretty big flow of capital. We saw probably about $20 billion of equity, based on the best estimates that we have, that make up just the equity portion of the projects they invest in. So there's probably tens of billions of dollars in projects, mostly in real estate, and we can talk about that, I'm sure you may want to, but also in other asset classes. We see this in manufacturing and energy and infrastructure, in technology company investments and others. And so we've got this marketplace. It's very disaggregated. There are lots of investors. Everyone's dealing with the pandemic in a way I think typical private equity and venture capital investors are dealing with. And then, of course, there's been a lot of commentary on how the program is working and whether it can be working better. But I think something that everyone would agree on, including the harshest critics, is that this program has served to catalyze this, not just a national conversation around this lack of investments in big chunks of the country, but also a number of regional conversations. And it's probably that aspect that's been most disrupted by the pandemic, because those gatherings they were happening every week, really, until March. They're not happening anymore. And that's, I think, slowed down a bit of that part of the marketplace. But there's lots of reasons to be optimistic about OZs sort of moving forward here. So that's a lot packed into one question there.
No, that's great. And I think sometimes, that stepping back is really useful. We've had, as you said, so many of these conversations about OZs, so setting the groundwork for what they are, I think is really important. One of the things I've heard from some of our clients is that one of the challenges with private equity right now is that people aren't going out to sites, going out to companies to visit, to do their diligence because travel. I'm curious, do you get the sense, and this is sort of jumping ahead, but in the OZ market, given sort of the localized nature of it in some cases, that may be ameliorated, and that actually, because sort of it's place-based in some fashion, that may help to facilitate investments that otherwise wouldn't be made?
Maybe. I mean, I think due diligence is still an issue for OZs. I mean, you got to realize with OZs, you're really overlaying a form of private equity or venture capital investing on this tax incentive. A lot of the same rules apply. You need deals to pencil out. You need to make sure you're doing the sort of underwriting and due diligence to make sure you're investing in something you think is worthwhile. What's hard about it is it's not just a 2 or 3 or 4 year investment. These are 10+ year investments. So there's a lot of hard work that has to go into it. What I think is different and what drives activity in the marketplace now in OZs is that all of this is time constrained in the OZ program. So there were a set of infrastructure built on OZs to encourage basically a couple of things. One, capital to be deployed really, really quickly. So funds have to deploy 90% of their capital within a year. And there's been some relief given to that because of COVID that enable another 6 months or so for funds to have, but they've still got to deploy capital really rapidly. So the pressure's on for those funds to find deals. And 2, they've got to invest equity, not debt. 3, they've got to invest over a very long period of time. And so that makes it hard. Now, what's interesting about it is this has become a very disaggregated market. So there are 500 funds or more all around the country, and there are local groups all around the country organizing around it. So I am part of lots of conversations that are still happening every week. I still think the due diligence aspect of this is hard, but because of all the pressure, deals are going forward because people got to get money out the door.
So the other, in addition to COVID, one of the other, and we're going to throw some of the big questions out at you first, and we can dig into some of the details. Obviously, one of the other topics that has roiled the country is around Black lives, racial justice, racial equity issues. I know it's early. I know that that's in the context of sort of mass awareness in this way. That's something that companies, investors are only starting to respond to effectively. And there may not be enough time to really determine what that impact is on OZs. Have you seen sort of racial justice issues enter as part of the conversation, particularly given some of the framing of sort of OZs and development activities?
Well, so in the spirit of OZs are overlaid upon existing kind of asset classes, this obviously is a part of the regular conversation when it comes to any kind of community development issues. And communities are by necessity engaged in those decisions because they need to get the permissions from the city to move forward. Those are heavily politicized decisions. OZ communities in particular are disproportionately non-white. There's 60% or so of opportunity zone communities are majority non-white, which means you've got a big chunk of America that is been left behind, not just because of economic reasons, but also because of structural racism and the way infrastructure was built around a big chunk of the country. This program isn't going to solve all of those issues, but it does give people an opportunity to participate in changing some of those trends. I think the other big trend is, and this was, Urban Institute recently put out a report on OZs. They've been following it pretty closely. I'd say they're among the more skeptical end of the of the kind of thought leadership around OZs. But in their recent report, their kind of first 2 conclusions were, one was the point I made earlier, which is that it's catalyzing this new ecosystem of community development. But the second one was a lot of that ecosystem are non-white fund managers, Black and Latino fund managers and entrepreneurs who are using this as a way to market to investors that were ordinarily hard for them to reach. And this question of access to capital is ingrained in a really difficult way in our system. Venture capital backed businesses, only 1% of them are African-American businesses. Only 10% of them are women-led businesses. Black communities are much less likely to have the kind of same community banking infrastructure to get the same amount of equity capital. And so again, those are problems that are really challenging to solve, and we've got to solve but we are empowering a new leadership or a new financial community around the country that are more likely to come from and understand those communities. And you've seen some high profile examples of that. Derek Morgan, who is a player from the Titans, who really focused on work in Tennessee and Atlanta. I work with Ozzie Aru, who used to run Tyler Perry's film studio in Atlanta, Lou Aldang in Chicago, Nipsey Hussle before he died in Los Angeles, and another great developer down there, Martin Moto, who focuses on South Central LA. I mean, there are lots and lots and lots of examples of folks who are using opportunity zones as a way to be able to build this investment management business that was ordinarily, I think, a lot, far more out of reach. To your first point, we've only had 1 year of investment in this program. It's a 10-year investment. There's a lot of building of this connective tissue happening right now, and it's really hard to judge what's happening at this particular phase. So a lot of this is anecdotal, but this is, I think these are some of the trends to be pretty optimistic about.
Yeah, no, I mean, it seems really powerful that both in terms of a direct place-based redevelopment strategy, along with sort of that connective tissue and building that connective tissue looking for the future is really meaningful as an outgrowth of the program.
I think so. It took decades for communities to get to where they were. A lot of the communities that are hardest hit now were not hardest hit in the 50s and 60s. You look at the transition in the Midwest, in Detroit, in Cleveland, and other cities that were Pittsburgh, that were the driving economic forces of the country, and now are kind of at the bottom of those cities that are growing economically. And there's all sorts of other issues. So these things are not permanent; they're cyclical, but they take a long time to resolve themselves. And this is a long-term process. So we're going to have to see the layers of investment and stakeholders that get baked into this program over the next decade.
No, thanks for that. I'll turn it over to Carolyn for some additional questions. Sorry, Bill.
So in addition to sort of some of these other questions that have come to light more recently, also, with COVID, have you seen the allocations of funds change since this program was first introduced? Perhaps developers were looking at more, I guess I was watching your Real Deal interview the other day, talking about sort of there was initially an appetite for large urban areas and large apartment buildings in those urban areas, but perhaps that shifted more recently as different developers and look at different areas now in the post-COVID world.
Yeah, well, so yes, I think the short answer is yes, but the question of how it's shifting is a little bit of a harder question to answer. I'll give you some of my senses talking to lots of both investors and fund managers in the marketplace. One, because the market now is predominantly around real estate is in a funny place for investors. I think certain asset classes in real estate are very challenging for investors to get their head around. Think hospitality, retail, office. I mean, the growth and change in teleworking, is that going to change the WeWork model, the shared space, the co-living, model going forward? It doesn't look like it's had the same kind of impact on residential. And most of opportunity zone investing is around building housing, building apartments, multifamily housing around the country. But where it's being built, I think it's probably changing. Actually, even before the pandemic, you saw growth, the biggest growth in communities that were really off the radar screen before: Baltimore, Detroit, Birmingham, Alabama, Philadelphia, much less so than in places like Seattle, Portland, Miami, New York, and in particular those first three, their opportunity zone communities sort of lost ground compared to these other cities. I think even more so now, places that start off very expensive, like New York City and San Francisco and Seattle, are just harder bets because they're riskier. And for a 10-year hold, you want to go to places where there's the most amount of room for growth and where you can buy assets cheapest. There is lots of dry powder in this market, though. So I think that, and that's true across private equity outside of OZs. There's $200 billion of dry powder, and has been for years, because people have been waiting for this end of the cycle and the beginning of the new one. So I think everyone wants to kind of wait and see as long as they can this year about which markets take off the most, about where COVID has the biggest impact, and about about what's coming back. That what's going to drive all of this activity, and that's true for OZs as well, is that there are more and more investors that don't have a lot of options right now. Treasuries are not the same bet as they were. Bonds are in a weird place. Public equities in a weird place. What are you going to invest in? I think there's a lot of interest in alternatives, whether they're investing in companies over the long term or in real estate, infrastructure, other physical assets. I think that all bodes well for opportunity zones. To the extent you've got dry powder, particularly because you sold during the this last market sell-off, and you can make the same kind of investment, but do it in a tax-advantaged way and do it in the type of communities now that are probably less risky bets for both cost and concentration reasons as in New York. I think that makes, that creates some very interesting opportunity zone strategies. But again, it's very market-based. So this all depends on what investors and fund managers from the bottom up want to see happen and what projects, communities on their end are prioritizing and putting out in front of investors.
So speaking of alternatives, do you see more or less appetite in OZ capital into the venture capital space or the small business investments in OZs?
Well, I would probably parse words there a little bit. This is not necessarily a small business investment program. It's an investment for growth businesses. Now, that could work really well with venture capital. The challenging part of a business investing in OZs is, while real estate and infrastructure, I think infrastructure is also a very strong, underappreciated asset class for lots of reasons here. While they're fixed in place and they're not likely to move, businesses, particularly growth businesses, tend to follow talent, and talent has tended to be concentrated in places like San Francisco, Seattle, and LA, DC, which is not to say there aren't talented people elsewhere, but if you're looking to hire a bunch of engineers, they are kind of self-isolating in different places. It's harder to find those businesses in other parts of the country. You've also got to commit to holding for 10 years, which in a real estate investment is not very challenging because you're taking in cash from rents that become pretty, regularized once you've built a project out. For business investing, it's different. You got to kind of go opportunistically when there's the right opportunity to sell or be acquired. So business investing is harder, but the returns for using this program are much, much bigger with business investment. Real estate investing is always constrained in how much it grows. It grows basically by the amount of rents you can bring in. And those rents, no matter whether you have rent control or not, are always constrained within a certain amount, so that the amount of growth in your investment is constrained. Maybe you're going to double or triple, maybe quadruple your investment. Obviously, when you're investing in growth businesses, you're looking for a much higher return, 10 times, 20 times, 50 times, 100 times, 1,000 times. And that times is basically a calculation of how much profit you're going to have. And in this program, how much profit you're going to have that's tax-free. So that's a big incentive to find or move companies to markets that are in opportunity zones where you can see all that growth. And obviously the benefit for the community is you're creating both local, wealthy, hopefully founders, entrepreneurs, and investors. And also you're creating a lot of well-paid jobs. And you've seen that example in places that have had big exits like Indianapolis and Birmingham, Alabama. In Birmingham, Alabama, you saw Shift, which is an Instacart competitor, get bought by Target for $500 million. And it really led to the redevelopment of the CBD in Birmingham, which has been a big user of the OZ program. Also has a lot of the same, race issues that, a number of other cities around the country have. So they're a really good example. You've seen very exciting things happening in Baltimore, both in the redevelopment of Penn Station in Baltimore, which is using OZ dollars, but also in the transfer of technology from Johns Hopkins into downtown Baltimore, which never happened before, because downtown Baltimore is a really challenged place to start a business. But now Johns Hopkins and other investors have been really motivated to grow those businesses in OZs in Baltimore. So there are lots of examples. Just today, there was an announcement in Erie, Pennsylvania, where the Erie Insurance Company is investing tens of millions of dollars with an OZ fund to redevelop its downtown and create businesses there as well. So I think these things go hand in hand. The businesses should naturally follow more real estate and infrastructure development. And I think it's just going to take longer, but you're seeing it happen right now.
I guess building on that, you touched on before sort of the community development approach, or what communities are looking for. Can you talk about how sort of community foundations, local nonprofits, local community development organizations sort of have been engaged in this process, and how you see that either shifting or how it could shift in the future?
Yeah, well, I think there's all sorts of roles for philanthropy broadly, both local and national. One role has been stimulating activity into the types of funds that philanthropy wants to see in this space. So to the focus of this call, impact-driven funds, who have a certain amount of reporting and transparency, that are subscribing to certain principles, have certain local equity requirements to what they're doing. Philanthropy is a big driver of that in this market, just as they are in the broader marketplace. Two, there's a lot of organization happening around the country that much of which is driven by local philanthropy, community groups, community development groups, community banking groups that are pulling together the city and developers and investors and outsiders to come in and look at the community. And three, it's around identifying projects and giving investors, I think, the confidence that those projects are going to have an easy path to being developed, meaning they're going to have the support, so they're going to be able to get the zoning and the permitting and the land use rules and whatever else they need to start to put money in the ground. And I think the other big thing to recognize, which we've sort of danced around, but and maybe self-evident to people, but a lot of people don't talk about it in this context, opportunity zone communities are really different from each other. There's not like one model of community. So the sort of issues and needs and controversies in a market like DC or New York is way, way different than if you look at a Dayton or a Cleveland. And that's way, way different than if you look at more rural communities. As those second type of communities, the rural and the mid-tier cities, gentrification is not an issue. It's literally not an issue in that they don't have enough investment for that to be relevant. The rents are just too low. It's also not an issue because they just don't have the same history to this as some of the other big cities on the coast. And the needs are different too. You may go to a rural area because you want to build agriculture infrastructure, you want access to cheap energy, you want to do solar panels. I'm working on the biggest solar project in the country just outside of Fresno, which is an OZ deal. Huge sustainable agriculture companies I'm working with another group that's building these out all around the country, and those are rural plays. In mid-tier cities, you see a different play altogether. You may see a more diversified form of real estate and also lots of infrastructure, because there's a need for broadband infrastructure and energy infrastructure and municipal infrastructure in a way you may not have in the bigger cities. And of course, in the bigger cities, you're going to have a lot of multifamily and apartment investment. It's not a judgment that one of those types of investments are better than others, but each community has different needs, and investors are really learning about this in real time as well. Most investors have not had a place-based thesis in the US. We have lots of emerging market thesis for outside the US, but no emerging market thesis for inside the US, which in some ways is shocking. And originally when this bill was being created, Opportunity Zones was first called, which now I don't talk about a lot, not a lot of people know, it's called domestic emerging markets. That sounded like too much of a mouthful of a name, and also that people might misconstrue what is meant by that. But it was meant to express there are opportunities for growth in all of these places. There are entrepreneurs in all of these communities. I've been a long-time partner with Steve Case and his Rise of the Rest tour, and it's the capital that's not finding them. So philanthropy has a huge role in helping to be magnets for this capital, because they're providing first loss capital, because they're helping subsidize fund managers who are doing the right thing, or because they're helping deals come to the forefront that communities are prioritizing.
So there have been multiple stakeholders that could benefit from these programs, and I guess who are the stakeholders that are sort of winning in this and getting the most benefit out of this? Like, is this working? Maybe it's too early to say, and we're only a year in and we've been stalled by the coronavirus, perhaps.
So yeah, now hard to really evaluate it, but I'll give you the best thermometer that I use. At the end of the day, the most telling stakeholders in the program, I think, because they're really at the crossroads between the public and private strategies here, are mayors and also governors, but really mayors. And so you have to understand a bit of the political dynamics too of mayors, governors, and the federal government. Those three groups do not like each other. They have totally different perspectives. They have totally different responsibilities, and they're constantly in conflict over everything. This is one of the few programs where Congress, mayors, and governors are really, really working together. States did not have to participate in this program if they did not think it was good for their communities. Governors had to pick their zones, and every governor picked it. Almost every governor which had capital gains tax, conformed their capital gains tax to the federal treatment, which means they went above and beyond what they needed to do and provided their own skin in the game. And then many states provided additional tax incentives. In Ohio, in Texas, in Maryland, in Michigan, in Illinois, you've got extra incentives in other places to invest, maybe in certain types of projects, more rural focused or manufacturing focused or whatever, but they're doubling down on this. And then there was just a big poll done of mayors by Boston University. It's called the Menino Survey. They do an annual survey of mayors, hundreds of mayors, and this year they focused on 3 issues. One of them was opportunity zones. And 2/3 to 3/4 of mayors said some remarkable things about the program. We think the zones were picked in the right areas. We think governors did a good job. We think the local communities know how to benefit. We are confident we're going to get capital into them. If you talk to virtually any mayor across the country, it's not every mayor, but virtually every mayor, regardless of political party, and keep in mind most mayors are really Democrats around the country, particularly in cities of any kind of size, there's a lot of enthusiasm about this. The Conference of Mayors have talked about opportunity zones at every one of their conferences since 2017. It's a big panel. It's a big discussion. You know, the mayors of Dayton, of Louisville, of Columbia, South Carolina, of Los Angeles, of big democratic cities or cities that have, large African-American or Latino communities, San Antonio, are very, very engaged in this program. Now, that doesn't mean they're all going to get capital, doesn't mean they're all going to get capital in the projects they want. There's still a market-based element to it. But that is the barometer I use. If we lose those mayors, we know the program is not doing what it set out to do. As long as we have them, we know it fits into this broader strategy. And in fact, it's facilitating, catalyzing strategies that never existed before. This program is imperfect. It's a big experiment, but it exists because we left this huge hole in public budgets and in corporate investing that hasn't been filled in 30 or 40 years. And this is an attempt to create a form of impact investing to fill it. And it may not work, but it's worth trying and not prejudging until we've fully exhausted all the options here. And I think so far the signs are good. Mayors are excited, lots of money in the program, lots of diversified funds, lots of asset classes, and growth in communities you weren't expecting. Those are all really good things. It hasn't yet solved all the problems. That is a standard that is crazy to hold to any brand new program. But after year 1, I feel pretty good about it. And I think we will have a chance to tweak this as we go along if we need to.
Sorry.
I tried to answer many questions.
Co-moderator miscommunication here between Perry and I. Apologize for that awkward silence. A lot of our constituency here thinks a lot about climate change and sort of using the opportunity zone or leveraging the opportunity zone legislation to help sort of further these projects that you mentioned, like this large solar panel project. I guess can you share other examples of successes in that space, or community solar projects or other clean energy projects that are taking advantage of this legislation?
Well, that's the one I'm closest to. I work with a few different funds that have an energy and infrastructure focus to their investing. Let me talk a little bit about that, get a little bit in the weeds on the technical details. One of the things that's really powerful about this program for infrastructure-oriented clean energy projects is the way it deals with depreciation. I know that sounds really boring, but depreciation is a core part of the investment model for any infrastructure project, and those projects tend to get accelerated depreciation. So stuff you could normally depreciate in 25 or 30 or 40 years, you can now depreciate in 5 or 10 or in some cases 1 year. And typically, when you depreciate, it means you're getting a big tax benefit now that you got to pay back later. In this program, you can depreciate something in 1 or 5 or 10 years, and when you sell it, you don't have to pay back the taxes for that depreciation. That's an enormous driver for investment in energy and infrastructure projects. And it is being used. Renewable energy is a very, very active asset class in this space across the board. I see it with logistics facilities. I see it in connection with manufacturing. I've seen it with electric car manufacturing. And then I've seen it with this big solar project. I say of the kind of traditional renewable energy investment classes, solar seems to be the biggest obvious user of it, because a lot of wind is offshore, and a lot of that may fall outside of opportunity zones, just the way the map works. Solar tends to use a lot of cheap land. And as a result of the fact, it falls within OZs, sometimes really big tracts that could be rural, that one census tract in a rural area could be hundreds and hundreds of miles, could be 1 square block in New York City. So you can take advantage of that size to do big energy dependent projects. So I'm seeing a lot of it, but again, it's all driven by the market. To the extent there are fund managers, developers, and investors that want to do it, there are partners there that have the deals or that have money or that have the land that they want you to do it on. And I think that's one of the things people are, in general, when they, to the extent there's a critique of OZ investing, it's really a critique of disappointment with how we invest as a status quo in this country, how people invest. They're largely return driven. They're not largely impact driven. I know you guys know that. This market is really only changing that at the margins, but I think it's a really good fit for renewable energy for people who are motivated to do those projects.
So if we could just break down some of these deals further to the extent that you can, right? So who are the investors? Are they more impact aligned investors? Are they traditional LPs? How are they doing the deals? Are they subsidizing, the equity with some sort of debt or mezz debt or philanthropic capital? And then what's their exit strategy, right? Because the real benefit is on the back end.
Jesus, Carolyn, so many questions, all in one question.
Well,
she was holding out to all those questions.
I can tell.
My daughter finally got out from underneath the table here and gave me my space to think, waiting for her to pop up like that guy. Yeah.
Let's answer all of them, and you may have to prompt me a bit. But in terms of investors, the investors are anyone with capital gains. That includes individual investors, institutional investors, corporate investors, and foreign investors, anyone playing U.S. capital gains. What it typically doesn't include, which is a big source of capital for private equity and just in general, are investors like endowments, like philanthropy, like pension funds, because they're tax exempt. And so what you've typically seen in the marketplace is retail investors, those who have had gains because of whatever, sale of a company, the sale of real estate, the sale of whatever, and that are tax sensitive. And you can kind of think of it that way, akin to like the philanthropic investment market, the charitable contribution deduction. It's that kind of market, except probably at a bigger scale, because if you're using this program, you have a meaningful enough capital gains to make all the kind of the homework you have to do worthwhile. And so the average investor size is probably investing, let's call it $500,000 or more in this program. Corporates are way underrepresented in this marketplace, and there's even more reason, given some of the recent changes in the tax code, where you would expect more corporate investors. Corporate capital gains are a lot different than individual capital gains. Corporations have ways to offset it in the tax code. They've built it in over decades and decades, where individuals really don't have the same amount of have the same way to do it. So that's why you see primarily a retail investor marketplace. Okay, that was the first question. Are they impact oriented? Not usually, but only because most investors aren't impact oriented. And this reflects the general marketplace. That doesn't mean there aren't impact investors in this market and there aren't impact funds. And I've worked with a few of the bigger ones, but it really reflects the overall marketplace and to the extent those investors have gains. And then there was a third part of the question. What was that?
Well, just on the exit, like who are they going to exit the solar panel community to?
Well,
like who's going to buy it?
Well, it's like for these investments to make sense as an investor, there has to be a buyer that's investing in the cash flows of whatever that asset is for a physical asset. So for whatever the project is, presuming that this is not, in some cases, these are, by the way, government entities are going to step in and take over those assets. So I work with a fund that works with a lot of municipal infrastructure projects, and the idea is help us build something over the course of 10 years that we really can't afford to build in year one, but we need. And that could be utilities, that could be school space, and this has been used and being used for charter schools. It could be used for university space. It could be used for hospitals now, given that they're facing such a short-term, maybe not temporary, but a short-term budget shortfall. And then at the end of the day, they lease it out and they buy it, at the end of the lease. So that's one model for a certain type of infrastructure project. But in your typical deal, you just have, institutional investors who want to step in and they want to buy a stabilized piece of real estate. They want to buy a solar farm for the energy output. Maybe you're selling it to the utility. All that functions just like the market. The only real difference is that you're incentivized to wait 10 years. You don't have to. You can sell before that. But if you really want the biggest part of the incentive, you got to sell it after. You got to manage it yourself, or have a third party that you're directing manage it, and then you got to sell it to someone else after 10 years. So it works just like the way the market would work now.
So you don't think that the investors or the developers try to get the buyers at the table in the beginning? I would anticipate that would be a huge risk mitigant in this
Yeah, it would be. It's very hard to do. Yes, you're totally right, but buyers are going to be hesitant to take the risk in the same way that funds don't want to take the risk. And funds at least are better situated to do it because they've underwritten and done the due diligence on the asset. But I think in the case where you've got a public sector like municipal buyer, that's what they're doing. They're saying, we're going to take the risk down the road. We know we're going to use this 10 years from now. We know we need it. It doesn't really matter what it costs. We need this asset for our community. And so we're going to buy it. That's not usually true in the private market. In the private market, people want to hedge until they get to year whatever. And there are exceptions to that, but I think that's generally the way I've seen it work.
Great. This is directed to not you, but to everyone that's listening. If you have any questions, feel free to write the questions in the chat. We have 14 minutes left. Glad to make sure that we get through those. Steve, to you now. One, if you have any questions for the chat, please feel free to share if we want to quiz people that are here. But second, do you see any more, or are there any plans do you expect any more clarifications, regulations, additional guidance from the IRS, from Treasury, sort of moving forward?
Yeah, well, this is a dynamic program. So the good news is we've gotten all of the core rules of the road in that last bucket of regulations Treasury and IRS put out in December. Just this year, we've gotten 2 more mini tranches of things that were some clarifications in April, and then in June, we got some additional timing and regulatory relief because of COVID that gave funds and investors a longer time to invest. So for example, you normally have 180 days to reinvest your capital gains into an OZ fund. Now you've got till the end of the year for most investors to reinvest, to give more time for them to evaluate the market and evaluate the funds. And funds they had until June, many of them had a date on June 30th, they had to deploy all their capital out, or 90% of their capital. And now they've got to the end of the year or mid next year to deploy that capital. So there's been more time given. There are also conversations happening constantly in the political and policy space. I'm not going to break any news when I say this is a heavily politicized program, because it's been adopted by the Trump administration as a key part of the Trump administration's reelection campaign, and that means a certain segment of Democrats have big problems with it. I wouldn't read too much into that as a statement of how either party feels about the program or what they would do with the program. But underneath that, there's a layer of conversations happening among a bipartisan group of members of Congress that are trying to find common sense fixes and tweaks to the program. The most obvious one is to provide more data reporting and transparency to the marketplace for everyone's benefit, so we can see what's happening. Congress can evaluate it better, Treasury can, investors can. That was built into the original legislation and was taken out for reasons that are not too important, and I think it's likely to be reinserted. 2, I think it's likely that the program will be extended in some form. Maybe that's by a couple years to deal with the regulatory slowness. Maybe it's an extension because of the nature of COVID, because of changing an economy around the country, or maybe it'll just be an extension for another 10 years at the end of this. But that's something to look at. And 3, I think to the extent there's been a critique on the program that both sides, supporters and opponents of the program, have looked at, it's been around the designation of communities that probably didn't deserve to be a part of the program and how to deal with them. And it's not really so much that the investment in those places is a huge policy problem, but it is a huge optics and PR problem for the program, because it creates examples of high rises being built and making that the face of the program, when that's really not what's happening in most communities. And I suspect both sides are going to want to deal with that issue in some way, maybe by carving out 100 communities that were probably too well off already to be designated for the program. The reason why I say I don't think that's a huge public policy concern is this is a very inexpensive program in the scheme of community investment programs. It costs taxpayers roughly $200 million a year. The new market tax credit costs taxpayers $3.5 billion a year, and it is a much, much smaller program in terms of the amount of capital it gets into communities. And so you're really talking about a rounding error in just about any federal budget, which is why I think it will have a long political shelf life to it, and why we'll have a lot of room to tweak it over time. But I'd rather everyone focus on how we really help make this work more in communities than focus on, the types of investments we're seeing here that, really don't fit the spirit of what this program was designed to do.
It's interesting to hear you say that there could be a 2-year extension, because if we had asked you that question pre-COVID, there was like there was no possibility of extension, right? Because this is managing some budgetary expectations. So
yeah, well, listen, I still think no one can count on the extension, but I do think Congress has much bigger fish to fry. And to the extent this is a tool to helping solve the biggest problem Congress has right now, which is the fact that we're back in a time of, if not officially economic recession, we're knocking on its door, and there are lots of people unemployed in the same communities that were impacted, in 2008 are the same communities impacted now. They need all tools at their disposal. That's what I would want if I were Congress. It's going to be a little dicey this year just because this is part of the 2020 discussion. I don't think it will be politically charged hardly at all in 2021 in the mainstreams of both parties. And I suspect there'll be appetite to extend this, maybe with certain, strings attached, like around reporting or transparency. But we've got much bigger problems now to deal with as a country. And I think that's surpassed whatever conversation we were having last year.
Okay, so we've gotten a few questions in the chat. I'm just going to see if I'm reading them real time, but so there are about 4 questions. So maybe 2 of them I can ask together because they're similarly situated.
Sure.
So given the current climate, are there any plans to reimagine the OZ program to directly impact, e.g. include as partners, the people from those communities who, as Steve noted, are often minorities who have historically been excluded from the asset class, rather than directly benefiting the investors who can afford to park their money in OZs for 10 plus years? A similar question, can you describe an OZ deal where you see all cylinders firing in a positive way in terms of benefiting the local community, and describe key factors for its success? Do you see helpful and necessary element coming from local community-based organizations or from others?
All right, I may need your help separating those questions again, but let me start with the first one, which is obviously a good question. It's a bit of a chicken and the egg question. And again, I'd put as a parallel, like charitable contributions. I mean, the money in this program are going to come from people who are already successful investors. That, for lots of reasons, isn't enough, of people who come from these communities, because they just aren't invested in the markets or in investments in the same kind of way. That doesn't mean those communities are not benefiting from this program. At the same time, investors are benefiting from this program. And this is at its core a philosophical question. Do you believe that there's a program, you can create a program and where investors see benefit over time and communities see growth and job creation over time? I believe the answer is yes. I think anyone in impact investing has got to believe that answer is yes, or at least not definitely no. And that is the philosophical underpinnings of this program, that if you can direct capital into places that are going to create the type of central business districts, infrastructure, and ultimately business creation, that's going to lead to a better situation than the status quo now, which in many cases has existed this way for the last 10 or 20 years. So I view those wins as being linked. I think they have to be linked. I think it's hard to see sustainable private investment going in places where investors are not going to see benefit given the way people invest in the US. And to the extent it's being targeted at cities and communities that are struggling, I think that's a big win. But everyone's going to make their own kind of philosophical conclusion on that, reach their own philosophical conclusion. And then what was the second question?
Can you share an example where you think you see all cylinders firing in a positive way to benefit the community? Is there some?
Yeah.
Aren't there shared community trust models that are being launched?
Yeah, there are. I mean, listen, the single most surprising example I'd say, which is not exactly that, Carolyn, but has some of those features, is Alabama. Alabama is not the place that when this program was being created, people would say, well, I know this program is obviously going to help Alabama. Alabama is not a hotbed of investment. But very early on, some key players in Alabama stepped up and said, we're going to leave our day job, which for I think the leader in that space, Alex Flashbart, was working at a prestigious law firm in Birmingham. I'm going to create something called Opportunity Alabama, and I'm going to use that as a way to bring forward to investors around the country the exciting deals I see around the state. And he's created $1 billion plus pipeline of deals in Alabama, and Birmingham in particular, but also Huntsville and some other communities have been big beneficiaries of that in terms of their way to create capital. The mayor of Birmingham, Randall Woodfin, his economic development director, and a number of other stakeholders locally have been engaged as partners in this with investors and this nonprofit entity. And so I think that's a really good example. What Alex is doing is amazing, but it's not like no offense to Alex, who's a friend of mine, it's not rocket science. He just stepped up and took the initiative to build this organization, identify the deals, market it to investors, and be kind of like the investor relations hub for the state. States do this already when it comes to foreign investment, or it comes for exporting or other things that they're used to doing. They're not good at doing it when it comes to private equity investment. And they do it with corporate investment all the time, which is, in my mind, a very controversial, challenged form of economic development. They don't do it in regards to individual venture capital and private equity investment, and I'm not sure why. I think because there's just less of a muscle memory and track record doing it. But the ones that are, and Birmingham is an example of that. The state of Colorado did it really effectively under Hickenlooper around rural Colorado, and there are funds that are just focused on rural Colorado communities and bringing investment there. And we talked about others. Erie really stepping up, has a philanthropic backbone, a corporate backbone, a city backbone, and a private investment backbone. It's maybe the poorest, if not one of the poorest, opportunity zones in the country in Erie, Pennsylvania, which if they can do it in those places, they can do it anywhere in the country, right? They had some attributes. They had a great insurance company. They had a great entrepreneur in Alex Flashbart. They had a great governor in Hickenlooper, but lots of places have those things if they're willing to organize around this. And I think you're going to see more of that. So those are just some of a lot of good examples of this stuff.
Great. If people were curious to try to find, sort of deals that are happening, or sort of communities that are doing good work, seeing what's happening around the country, is there any sort of one database or a couple databases that you'd suggest looking at, knowing that a lot of things are still private? But you mentioned Brookings, I think, has some. Who look at?
I'm not sure there's anything comprehensive. There are a few groups that do a good job of tracking this. Novogradac, an accounting firm, does a pretty good job of tracking this. The Urban Institute is doing some of this. The Economic Innovation Group, my former stomping grounds, actually has a national map of investments that fit the spirit of the program. They have hundreds of investments of places where this is happening. But again, this is a very disaggregated private sector, privatized marketplace. And it won't be, I think, for a few years until we're able to collect the data and report on it, which eventually is something that Treasury will do with Congress, that we're going to fully learn all this stuff, and everything else is anecdotal. The other place is the Sorensen Impact Center, which has been very involved in this in Salt Lake City, Utah, has been recognizing some of the best examples of OZ funds around the country. In fact, many of the ones that I talked about, Colorado and the Rural Fund, Alabama, Erie, and then the other one was Martin Moto's fund, SOLA in South Central LA. So they every year their conference in Salt Lake City in January, February, they do a big chunk on opportunity zones. So it's really come up ground up in terms of the recognition of those really good examples. And frankly, you guys have done a great job of it. I mean, I've been talking with Nexus since before this was even a program, and I know you guys are on the radar screen of a lot of the up and coming impact investing leaders in this country. I think the most challenging thing for this community is going to be to separate the politics and the controversy from finding investment and projects and fund managers and communities that they think are doing powerful things with private capital, and where they can, make their capital go farther. And that's all this is. It's just a form of capital. To Carolyn, I remember in your earlier question, you asked, does this fit within other capital stacks? This is just equity. It fits within the capital stack like everything else does. If this makes your capital go farther, makes projects pencil out a little bit lower, it makes these deals more competitive, then hopefully everyone will use this program for whatever they're interested in investing in.
Great. So maybe we'll give Steve just a few minutes for our closing thoughts. And we've been entirely off script most of this conversation. So thanks I know Steve is up for that and able to handle that. But so maybe the last question that we'll ask is just if you have any sort of call to action of our constituency here. Like, I think a lot of us chomp at the bit to figure out how we can get involved from different perspectives. And our constituency is various from retail investors to mid-level professionals at large financial institutions. And I guess, is there a call to action that you can put out and how people can get involved? But before I do that, I just want to make a quick shout out to thank you, Scott, and his team for helping us put together this event and get the word out. We do have 2 more upcoming events. one on July 9th, and how ESG funds have weathered recent market volatility, led by Jennifer Leonard at Cornerstone. And also later in July, an event on talking about sort of specific water and how companies are addressing water issues and trying to reach water net zero. So that was Steve's sort of breathing room to see how we can, have this last closing thought.
Well, I'd say the call to action is actually pretty simple. I mean, to the extent everyone's active in either investors or fund managers or developers or whomever, first step is take a look at the map of opportunity zones. I mean, I've got one on my website at Develop Advisors. There are a lot of other maps. I also done an economic analysis of every OZ in the country to give folks a sense of how zones compare to each other. But you'll see that there's a real big diversity of communities to invest in, and overlay the sort of things you're interested in investing in. Use that as a model to identify places that are at least in need, even if you're not going to use the investment as an incentive. And know that this program is very flexible. You can do any project, whether it's venture investing, real estate development, infrastructure investing, that you can do outside of opportunity zones, in opportunity zones. You just will have a much more competitive cost of capital for your equity. And to the extent people need help, they're doing projects either, I obviously have a consulting business, which, frankly, I just work with a pretty small group of clients, but I know a lot of the players in this space, the accounting firms, the law firms, the fund administrators, the other kind of folks in this market who are actively engaged, including around the impact space. And I'm happy to get people oriented with support they may need to figure out the nitty gritty of how these funds work and the rules of the road here. But at the end of the day, anyone can participate in this program. There's no minimum investment. There's no maximum. You can use whatever percentage of your capital gains you want. And frankly, you don't have to invest capital gains if you don't want to. These are places that cities, states, and the federal government have identified as being big focus areas for the next 10 years. And it's, we're going to need the private capital to change their trajectory from where it is now to where it might be, 10 years from now.
Great. Well, that is perfect timing. I think a great call to action, particularly for, in our current time where everyone is in different places, not necessarily in the communities that they thought they would be in right now. And, thinking about what the future holds. So, Steve, really appreciate your time. The three of us have had this conversation a couple of times, and I think it just is always interesting sort of where things are and where where you see the direction shifting or the wind shifting, but also how consistent it's been throughout. And I really appreciate that sense of optimism in terms of where this program is and looking for the positive pieces of it and where it can go and, I think really be transformational in many ways. So thank you again for your time, Carolyn, thank you. And to all the participants, thanks for your questions, for attending, and we'll, if you want to be in touch with Steve's contact information is available, and we're around to answer any questions. So thank you, everyone. Stay safe. Happy 4th of July.
You guys too. Thanks, Perry. Thanks, Carolyn.